Warren Buffett is a well-known billionaire who has consistently ranked high on Forbes' list. His net worth was $80 billion in October 2020. Buffett is a businessman as well as a philanthropist. He is perhaps best known as one of the most successful investors in the world. It's no surprise that Warren Buffett has become a legend for his investment strategy. Buffett adheres to a number of important principles and has an investment philosophy that is widely adopted around the world. What are his secrets to success? Buffett started his career in investment sales in the 1950s. He founded Buffett Associates in 1956. He was in control at Berkshire Hathaway in 1965, less than 10 years after he started his career as an investment salesperson. Buffett declared in June 2006 that he would donate all of his fortunes to charity. In 2010, Buffett and Bill Gates created the Giving Pledge campaign in an effort to inspire other wealthy people to support philanthropy. The Buffett Methodology. Warren Buffett looks for low-priced values by asking questions as he examines the relationship between stock's excellence and price. Company debt. Buffett also carefully considers the debt-to-equity ratio. Buffett prefers to see less debt to ensure that earnings growth is generated from shareholder equity, rather than borrowed money. Debt-to-equity ratio equals total liabilities, shareholders' equity. This ratio is a measure of the amount of debt and equity used by a company to finance its assets. The higher the ratio, then, the more debt is financing the company. High levels of debt can lead to volatile earnings and high interest costs. Investors may use long-term debt as an alternative to total liabilities for a more rigorous test. Is the company public? Buffett tends to only consider companies that have been around at least 10 years. This means that most technology companies that have gone public in the last decade won't be on his radar. Buffett has stated that he doesn't fully understand the business processes behind many technology companies today and that value investing means identifying companies that are well respected but still undervalued. Never underestimate the importance of historical performance. This shows the company's ability to increase shareholder value. However, past performance is not indicative of future performance. Value investors are responsible for determining how the company can perform in the future. This is a difficult task. Buffett excels at this task. Remember that public companies must file financial statements on a regular basis. This is a requirement of the Securities and Exchange Commission. These documents will allow you to analyze important company data, including past and current performance, so you can make informed investment decisions. Performance of the company. Sometimes, the stockholders' return of investment, ROE, is also known as return on equity. It is the rate at which shareholders receive income from their shares. To determine if a company has performed consistently well in comparison to other companies within the same industry, Buffett looks at ROE. The following is how the A is calculated. ROE equals net income, shareholders' equity. It is not enough to look at the ROE for the past year. To analyze the historical performance, the investor should look at the ROE over the past 5 to 10 years. Profit margin. Profitability is not just about having a high profit margin. It also depends on how consistently it is growing. The net income divided by net sales is how you calculate this margin. Investors should look back at least 5 years to get a good idea of historical profit margins. High profit margins indicate that the company is doing a good job in managing its business. However, increasing margins can also mean that management has been very efficient and successful in controlling expenses. Is it cheap? This is the real kicker. This is the kicker. It's Buffett's most important skill. An investor needs to determine the company's intrinsic worth by analyzing a variety of business fundamentals, including earnings, revenues, assets, in order to verify this. The company's intrinsic worth is often higher than the liquidation value. This is the value of a company if it was sold today. The liquidation value does not include intangibles like the brand value, which is not stated on the financial statements. After determining the intrinsic value of the company, Buffett compares it with its current market capitalization. This is the current total worth or price. Buffett's unmatched ability to accurately determine this intrinsic value is what makes him a success. We can only outline some of his criteria, but we don't know how he was able to calculate value so accurately. Commodity reliance. This question might seem radical at first. Buffett sees this as a crucial question. Buffett tends to avoid companies whose products can be distinguished from those of their competitors and those that only rely on oil and gas as a source of income. Buffett doesn't believe a company can offer something different than another company in the same industry. Buffett refers to a company's competitive advantage or economic moat as any characteristic that is difficult to duplicate. A competitor will have a harder time gaining market share if the moat is larger. Buffett's style of investing is similar to that of a bargain hunter. It is practical and down to earth. This attitude is also evident in his daily life. Buffett doesn't own a large house, doesn't have a collection of cars, and doesn't drive a limousine to work. While the value investing approach has its critics, Buffett's style isn't without its merits. But, whether you agree with him or not, the proof is in his pudding. There are some best offers given in the description below, so don't forget to check them. If you like the video, then like and share it and give your opinion through a comment. If you haven't subscribed to this channel yet, then do it now and also press the bell icon so that you can get notifications of my future videos. Thanks for watching.